I'm James Foster, co-director of the Institute for International Economic Policy at the George Washington University. Thank you for joining us today for a presentation and discussion of the International Monetary Fund's flagship publication, The World Economic Outlook, which is the fund's assessment of the state of the global economy and its future prospects. The GW community is grateful to our next-door neighbor's continuing collaboration that benefits students and faculty all across our campus, in the Elliott School, the Department of Economics, the School of Business, the Law School, Political Science, and especially here in the Institute for International Economic Policy. For those of you who have not yet participated in an IIEP event, you can expect a lively and informative conversation on such topics as US-China economic relations, urbanization, multidimensional poverty, global economic governance, green finance, and digital trade. Our Facing Inequality webinar series is a multidisciplinary conversation, bringing together historians, political scientists, philosophers, legal scholars, public health professionals, and economists to address what is perhaps the main socioeconomic challenge of our age. Our Envisioning India series convenes experts from finance, economics, and the academy to speak of India variously and so reveal its reality. Previous contributors have included DC regulars Raghu Rajan and Rakesh Mohan, while next week Rohini Pandey and discussants Ravi Kanbar and Jayati Ghosh will join us for a conversation on India's COVID-19 response. Finally, our 13th annual US-China Economics Relations Conference gets underway this Friday with a keynote address by Carmen Reinhart, Chief Economist at the World Bank, on debt in a post-COVID world. IIEP affiliates, Graciela Kaminsky, Maggie Chen, and Danny Leipziger will initiate question time during the first episode of our serial conference. If you miss any of our events, videos can be found on our YouTube channel, IIEP GW. And now to introduce and moderate today's event, I'd like to present IIEP co-director Jay Shambaugh, who's just returned from directing the Hamilton Project at Brookings, and before that was visiting scholar with the fund, and before that served twice in the White House Council of Economic Advisors. Welcome back, Jay.
Thanks very much, James. It's great to be here with you, and in particular, great to be here at this event. The World Economic, or WEO, is the flagship publication of the IMF, and I can say from having spent time in policy circles, it makes a big impact when it comes out. It gives us a sense what the fund thinks the global economy is, but also the fund always provides some very interesting analytical chapters that are thought-provoking and start a lot of discussion in policy circles. In normal times, events like these are great because the IMF scholars just walk 2 blocks down the street and join us in our venue. But for now, we'll have to greet virtually. We're also thrilled to greet terrific discussants from outside the fund to discuss each chapter as we go along. Remind everyone to please put any questions you have in the Q&A part of the WebEx system you're watching on here. And so after the presenter discussant, I'll then monitor the Q&A and forward those questions on to the presenters. So we're going to start off with Chapter 1 of the WEO, which is always very hotly looked at immediately as people try to figure out what does the fund think the economy is doing right now. And so we have Malhar Nabar, who's a division chief of the World Economic Studies Division, IMF's research department, who is going to present the chapter. And after that, Claudia Sahm from Sahm Consulting will give remarks. Claudia is a longtime researcher at the Federal Reserve, and I had the great pleasure of working with Claudia at the White House Council of Economic Advisors for a year. So I'll now turn it over to Malhar.
Thanks, Jay. Thank you, James. Thank you to GW for hosting again. We're delighted to be with you. And thank you, Claudia, for making the time to discuss this first chapter. So I'll kick it off with a quick overview of the main chapter and then turn it over to my colleagues, Francesca and Florence, to walk you through the analytical chapter. So over the next few minutes, I'd just like to give you a quick overview of the main themes of chapter 1 of the WEO, which is our look at the the global outlook and the risks and key policy priorities. Just by way of background and to set the stage, by now it's quite familiar that we are in an unprecedented recession. For next year, we're projecting a partial recovery, which is partial because even though we have a strong bounce back in global growth, global activity levels will continue to remain well below the levels that we had projected pre-pandemic. And it's also uneven because there's some parts of the global economy that are projected to bounce back a lot stronger than others, and we'll go through those details in a second. There's a lot of uncertainty around these projections, partly related to the pandemic itself, and we're seeing a resurgence in Europe, for example. It still is spreading relentlessly in many emerging market and developing economies, and there's huge uncertainty about the future pathways of this pandemic and the domestic economic disruptions that it will bring in its wake, and the global spillovers as economies go through this together in a synchronized fashion. In terms of the policy priorities, this is a report that covers 190 economies. So clearly, we don't go into the details of each individual case, but unusually, this report, as was the case also in April, allows us to draw some cross-cutting themes because everyone is going through the crisis together. And in the report, we go through some key priorities, both at the international level, in terms of areas that we see need for greater coordination, both on the health front, but also on the dimension of providing liquidity support and financial assistance to constrained countries. And we also take a look at priorities at the national level, both in terms of the health priorities, but also policies that can help limit the persistent damage from this crisis. In this report, we're also outlining some priorities for looking at medium-term challenges to foster a more equal recovery and a recovery that places us on a path to lower carbon dependence. So with that as background, let me just walk you through the details of where we are right now and how this informs our view on what to expect going forward. So the main theme really is that the global economy is coming back, but there's a lot of uncertainty, and the recovery remains prone to setbacks. Let me just look back a little bit at the first half of this year, because this is important. It sets the stage for the forecast. It helps us think about the outlook. It's the starting point for the forecast. This has really been a very unique recession, and the chart here looks at the contribution to GDP value added from a sectoral perspective for a sample of advanced economies for which we have the data to do this. I've highlighted 3 bars here. The one in green, that's manufacturing. The ones in red are the contact-intensive sectors. It's wholesale and retail trade, recreation, etc. Typically in recessions, it's the green bar that tends to drag the most, that's manufacturing. But in this case, even though manufacturing has been hit quite hard, it's really the services and the contact-intensive services that are dragging global growth lower. And this has a bearing for the recovery path going forward as well, because obviously, as long as people are nervous about interacting in the way they used to, as long as we need to resort to renewed lockdowns to slow face-to-face interactions and to slow transmission, this will prevent these contact-intensive services from returning to any semblance of normalcy. And therefore, it will prevent the global economy from returning to any semblance of normalcy. In terms of the second quarter outturns, which we have data for right now, and we're now seeing third quarter outturns beginning to trickle in. Second quarter really has a mixed bag of outcomes, but it's useful to classify these outcomes into 3 buckets. There's China on the extreme left, which surprised us on the upside, a very strong recovery in the second quarter. We had projected a strong recovery in the second quarter after lockdowns were eased in China starting in early April. But the actual recovery surprised us on the upside, thanks to an outsized public investment response, and also because China's exports, particularly of electronics equipment to support work from home and also medical supplies, bounced back a lot stronger than we had expected, and that lifted GDP growth in the second quarter above our projections. The second bucket is a group of economies here in the middle, which is the advanced economies, where we saw unprecedented contractions, very severe downturns, but not as dire as we had projected. And this has to do with a combination of economies coming back stronger than we had anticipated after lockdowns were eased in May, but also because of the unprecedented policy support in advanced economies that helped cushion some of the impact. So although a very deep downturn, catastrophic hit to the labor market in many economies, it wasn't as bad as we had projected back in June. And that helps put us on a slightly stronger footing for the outlook going forward. And then there's a third bucket, which is really where the mixed bag of outcomes is. And this is the emerging market and developing economy group outside of China. And here we've seen some economies such as India, Mexico doing a lot worse than we had projected. But others such as Brazil and Russia, although they experienced deep downturns, similar to the advanced economies, the downturns were not as deep as we had projected. So what does this add up to when we put these three buckets together? Essentially, GDP growth in the second quarter was a little bit less severe or less dire than we had projected, and that places us in a slightly better place for the forecast going forward. If you look at the third quarter, the good news is that the recovery has continued into the third quarter, but at a slightly slower pace, the deeper we've been getting into the quarter. And that's not surprising because you have this mechanical snapback the moment you reopen, and that happened in June, which was in the second quarter. That snapback starts fading a little bit in July after the pent-up demand starts washing itself through the system, and it fades even further in August. And the chart on the left shows you that this is true for many economies where, in sequential terms, industrial production accelerated very sharply in June and then began slowing, although still in positive terms, in July, and further slowing in August. In terms of where we are relative to last year, the chart on the right shows you that for many economies, we're still well below levels of last year, so a long climb ahead. But the good news is, at least in sequential terms, we are doing better than we were back in May and June. A similar picture emerges if you look at retail sales, where again, if you look at the chart on the left, that's the sequential momentum. We had very strong recovery in June when stores reopened and bigger chunks of the consumption basket became available for consumers to access. But from that point on, there's been a bit of an easing in the speed of the recovery. And again, in year-on-year terms, the chart on the right shows you that for many economies, we're still operating well below the levels of last year. But for some, there has been a bounce back above the levels of last year, in part reflecting weak base effects from exactly the same period 12 months ago. Now, as I mentioned earlier, this is an unusual recession because of the deep hit to services, especially contact-intensive services. And this is also reflected in the trade outcomes that we're seeing. The chart on the left, if you focus on the line in red, that shows you the contraction in trade volumes. Trade did take a deep hit, but perhaps not as deep as might have been expected given the size of the GDP downturn. And that has to do with the fact that typically in recessions, manufacturing is the sector that takes the biggest hit, and manufacturing is intensive in trade, components, final goods going back and forth across borders, and trade therefore takes an outsized hit during recessions. In this instance, because it's services that have taken a bigger hit, trade, while it has contracted sharply, is perhaps not contracted as sharply as might have been expected given the overall size of GDP decline. But if you look at components of the balance of payments where the services are recorded, and this is the chart on the right, shows you particularly focusing on travel and transportation. For the economies for which we have data here, the first half of this year, the bars in red are well below the comparable bars from a year ago, the first half of 2019, showing you the contraction in services balance, especially in travel and transportation, as these components have taken a hit with the stop in cross-border travel that we've experienced since March and April. Now, as I mentioned, this has really been a calamitous hit to the labor market, for example, in the United States, but also in emerging market and developing economies where many workers are employed in the informal sector without access to social safety nets, often in situations where they work far away from traditional support networks, migrant workers in particular. So a really catastrophic hit to the labor market. In some parts of the world, short-time work schemes, particularly in Europe, have helped cushion the blow, have kept employment ties alive between workers and firms. And so the hit to employment has been much less in Europe. The good news is that the employment levels are coming back. That's the chart on the left. And this has occurred even as mobility remains depressed. And that's the chart on the right, which shows you, if you look at the dashed lines, mobility both in advanced economies and emerging market economies remains below baseline. But even with the subdued mobility, we're seeing a recovery in employment, which suggests that employers are beginning to be a little bit more confident about the strength of demand and are beginning to rehire, to bring back furloughed workers. And all of that, of course, is good news. And it suggests that we have, in some parts of the global economy at least, found some ways to deal with this environment of reduced face-to-face interactions and to restart our economies in ways that are compatible with social distancing. Now, of course, mobility remains depressed because the pandemic continues to spread relentlessly, and the charts, the various versions of these charts that I'm sure all of you are familiar with, but the charts here essentially capture new confirmed cases on the extreme left and deaths in the middle. As you see, the distribution of new cases has shifted away from Europe and at the start of the pandemic to more to Latin America, to South Asia, to the United States again, a resurgence, and of course Europe also experiencing resurgence now. The good news is, at least in terms of recorded fatalities, and this is just direct COVID fatalities, this does not include fatalities due to other conditions that were not addressed because of fears of contracting COVID. But at least in terms of COVID-related fatalities, there seems to be a dip in fatality ratios, and that suggests either the demographics of the infections have changed now to less vulnerable people, younger people, but also that the medical interventions, the therapies, there's been some improvement on that front, and medical professionals have a better sense of how to treat these infections, whereas back in the spring, they were confronted with a threat that they'd never seen before and were experimenting with different approaches. So all in all, a decline in fatalities, but still a very large number of deaths, and that's, of course, contributing to the fear factor and the depressed mobility that we're seeing. In response to this resurgence, governments have also slowed their reopening. The chart on the right shows you the stringency of lockdowns, which had peaked in April and May, the line in red. And that came down in June, continued to come down in July, but and into August, but has slowed. And of course, in some places, we're seeing renewed localized lockdowns. What's been interesting, of course, in the past 6 months has been this massive policy response to combat this crisis, both on the health front and on the economic front. This has been particularly the case with advanced economies, which have the latitude to do this. They have the issue in reserve currencies, and they're able to borrow to support the additional spending needs. The chart in the middle shows you that both in terms of direct measures, this is tax deferrals and that revenue measures such as tax deferrals, as well as spending measures such as additional health spending, transfers to households, wage subsidies. Advanced economies have been able to provide a much larger share of support as a fraction of their GDP. And on top of that, they've also provided credit guarantees, loans, equity injections. That's the component in red, all of which adds up to close to 22% of GDP in advanced economies. Emerging market and developing economies have also done as much as they can, but they've done less because they just have less latitude to do this, both in terms of limited fiscal space going into this crisis, but also they don't issue debt in currencies that are widely accepted, and that limits the ability to borrow to fund these crisis-related expenditures. But nevertheless, there's been a big, sizable response in some economies such as Brazil, even South Africa, and others that have come to provide large amounts of support, direct support, as well as loans and equity injections and credit guarantees to cushion the damage and to cushion the impact of this unprecedented crisis. There's been Significant shifts in a monetary policy stance as well, particularly in the US, where the Fed rapidly cut the federal funds rate down to zero. Euro area, ECB, and in the UK, the Bank of England had less room to do that on the interest rate front, but certainly in terms of asset purchases, especially with the ECB, a big ramp up in asset purchases, new facilities that were introduced, and in general, a very strong response from advanced economy central banks, which has eased financial conditions globally since March, but has also provided room for emerging market central banks to come in with their own supportive measures, interest rate cuts, and also for the first time, asset purchase programs in several emerging market economies to provide additional support and monetary accommodation. All of this, the fiscal response, the monetary response, has prevented a far worse outcome from occurring, even though the outcomes themselves are very bad at this point, and of course the hit to employment is very bad. They could have been a lot worse without these aggressive countermeasures. So where does this leave us in terms of the projections? First of all, just very quickly, because of the huge uncertainty around these forecasts and how closely they rest on the assumptions with respect to the pandemic, what we're assuming with respect to the pandemic is that social distancing will persist into next year, but then gradually decline over time as medical interventions improve and as vaccine coverage increases. By the end of 2022, we assume that local transmission will come down to low levels everywhere, and that will allow cross-border travel to resume and help us achieve a semblance of normalcy again on that front. Of course, there's some parts of the world which have done better. They have a better handle on controlling local transmission. I'm thinking of East Asia here in particular. And those areas will, of course, get to low levels of local transmission, are assumed to get to low levels of local transmission sooner than other parts of the world. But the key assumption here is that globally, everywhere, we assume that local transmission will come down to low levels by the end of 2022. And this is based on conversations with epidemiologists, with the World Health Organization, and from canvassing expert opinion on this front. In terms of the policy support, it's typical IMF practice to only factor in the announced and implemented measures. So we don't have any anticipated measures, anything that's in the pipeline. So despite all this talk about the stimulus in the US, that's not a new stimulus in the US, that's not in our baseline projection. And of course, if that were to be legislated, that would represent an upside to our forecast that I'm going to discuss in a second. So in terms of the numbers, very quickly, global growth, we're now projecting to contract by 4.4% this year. It's an improvement from our previous forecast because of the faster normalization and activity than we had anticipated after lockdowns were eased, particularly in the advanced economies, but also in China. And then next year, we project a bounce back in global growth to just over 5%. So if you put those two numbers together, -4 this year, deep dive, and then this recovery next year, 5.2, that leaves global activity, the level of global activity, just a modest 0.5% above the pre-pandemic level, 2019. Now, if you look at the projections for advanced economies on this slide here, what you can see is that the deep downturns pretty much across the board this year, followed by these snapbacks in growth next year. But the combination of the two leaves activity for advanced economies below pre-pandemic levels, even by the end of 2021. The only exception here is Korea, where we have this improvement next year, which will bring activity above pre-pandemic levels, and that's partly to do with the fact that Korea is in that group of East Asian economies that has done a better job than elsewhere in bringing transmission down through contact tracing, isolation, and of course widespread testing. And they have not had to resort to the kind of stringent economy-wide lockdowns that we've seen elsewhere. And that has helped provide a slightly better outlook for this year, more modest contraction than in other advanced economies, but then also sets the stage for this recovery next year. In addition to that, Korea has also had a sizable policy response, both on the monetary front, but especially on the fiscal front. Now, advanced economies as a whole are not projected to return to levels of pre-pandemic activity by the end of next year. However, global the global economy as a whole is. So clearly Korea itself is not going to get us there. What gets us there is this group of economies, and this is the emerging market and developing economies, where, again, an unprecedented contraction of just over 3%, followed by a sharp recovery of 6% next year. And that's what lifts global growth, global activity above pre-pandemic levels. But if you zero in on this group and you separate China from the rest, China has a very robust recovery, thanks to the factors I mentioned earlier. First of all, getting the pandemic, getting the health crisis under control relatively quickly, but then also with very strong policy support and the recovery in exports, and that's projected to continue into next year. But if you take China out of that group, emerging market and developing economies, excluding China, again show the profile of advanced economies, which is that they have a deep downturn this year, followed by a partial recovery next year, and they're not expected to regain pre-pandemic levels. And that has a lot to do with the other economies in this group. The second largest emerging market economy, India, for example, where domestic demand has plunged this year as the pandemic has been difficult to control, and it's a partial recovery that's expected for next year. And a similar picture for the commodity exporting emerging market economies, where there's deep downturns this year, followed by recovery next year, but again, modest recoveries. So on the whole, global growth, we see a strong recovery next year of 5.2, but it's a partial recovery, and it's driven by the emerging market group. And within that emerging market group, it's driven to a large extent by China. So overall, a very somber picture for the global economy as a whole. And as I said, this recovery itself is subject to setbacks and huge uncertainty. So in terms of the uncertainty and the risks around this, there are no surprises here. Many of these are easily predicted in terms of the risk factors. On the downside, of course, we worry a lot about the pandemic itself, the possibility of a resurgence. We're already seeing that in some parts of the world. And we worry that in a situation of a synchronized downturn, that the cross-border spillovers could amplify and reverberate and weaken global growth. Policy support has been vital to preventing worse outcomes, but a premature withdrawal of policy or poorly targeted measures could exacerbate the problem going forward. And we worry about the state of financial markets. Financial conditions have helped so far since March at least, but there is a sense of a disconnect between asset valuations and the real fundamentals. And if that disconnect were to correct in an abrupt fashion, tighten financial conditions globally, there are some vulnerable borrowers, both on the corporate side and on the sovereign side, that could experience shortfalls, difficulties in rolling over debt, and especially on the sovereign side, could be tipped into debt crises. Beyond these near-term factors, we also worry about long-standing tensions in the global economy on the trade front, on the geopolitical front, and of course the ever-present threat of intensifying climate-related disasters. And Florence will be going into a deeper discussion of climate, but this is something that we're seeing in various forms across the world: Australia, California, East Africa, South Africa. It's Southern Africa, South Asia, whether it's excessive flooding or droughts or wildfires. They inflict huge humanitarian tolls and weigh on activity. Now, on the upside, of course, as I said, the extension of policy support could lift growth above our baseline. But importantly, if there are developments on the vaccine front and on therapies which allow for normalization of activity faster than what we're projecting, that would certainly help improve outcomes relative to the baseline. I just want to mention one thing on the outlook over the next 5 years that we're projecting, the medium-term outlook. This deep downturn, of course, will leave behind persistent scars, damages to the supply side of the economy, and we worry about the progress on improvements in living standards. The chart here summarizes the deteriorating picture on this front. The bars in red show you our current projections across the three groups: the advanced economies, the emerging market and developing economies, and then the low-income countries. The bars in red show you the cumulative growth over the next 5 years that we're projecting for per capita income. So, for example, the emerging market and developing economies, we expect GDP in 2025 to be about 15% higher than in 2019. This is well below the cumulative increase that we were projecting pre-pandemic, where we had expected that group to have per capita income level about 23% above its 2019 level. The squares in black are there for reference, just to give you a sense of what the cumulative growth was over the preceding interval of similar length. As you can see, apart from the low-income countries group, the other two groups are expected to register slower pace of improvement in living standards relative to the preceding 5-year interval. The setback to the pace of improvement in living standards, of course, reflects the damage to supply potential. The damage to supply potential also brings with it challenges to debt sustainability, is a smaller tax base which can finance the expenditures going forward, and also smaller tax base to support the debt service costs that are going to be incurred as a result of this pandemic, adding to the high levels of debt that we had going into the crisis. And the chart on the left shows you the increase in debt levels to unprecedented magnitudes, both for advanced economies and emerging market economies. And this, of course, brings with it its own challenges of debt service, with an increasingly large share of tax revenue eaten up by servicing the debt, and with less left over for financing critical social spending needs, health spending needs, and, of course, capital outlays. So let me very quickly close with the policy priorities. As I said, this is a report that covers 190 economies, so we don't take deep dives into individual economies. That's done in our Article 4 reports. But in terms of cross-cutting themes, for the here and now, the near-term priorities, on the multilateral front, of course, the key priority is to provide support to healthcare systems, including advanced funding for vaccine research, but also importantly to continue providing liquidity support for financially constrained countries. And the IMF has been central to these efforts, with unprecedented support, both in terms of the scale, but also the speed at which emergency support has been dispersed to constrained countries. At the national level, the priorities on first and foremost to get the health crisis under control, regardless of whether you've gone past peak infections. There's always a risk of resurgence. But at the same time, to also complement that with policies that help limit persistent damage. And to do this in a way that keeps an eye on medium-term goals, such as ensuring the recovery path is one that's associated with less carbon reliance, but also a recovery path where the gains are distributed equally, and we prevent a widespread increase in inequality, which is a big risk coming out of this crisis. Looking further beyond and just picking up on this last thought, there are long-standing challenges on the trade front, trade tensions, technology tensions, the bifurcation of technology platforms, especially on 5G, but more broadly. And of course, again, just on the climate front, which is something we've been bringing to the global policy community's attention for several reports now. And I think this report in particular, with the chapter that Florence will cover, we drive home that message even more forcefully about the urgency of implementing mitigation commitments to slow emissions, to slow the pace at which temperatures are rising. In terms of medium-term challenges at the national level, there are legacies that were already there from the previous crisis. There are new legacies that this crisis will leave: slow productivity growth, rising inequality, but an interesting new challenge, and this is the setback to human capital accumulation because of the school closures that we've experienced, which will affect individual earnings prospects, but also productivity growth going forward. So let me stop there and hand it over to Claudia. Thank you.
Great. Thanks very much. Claudia, I'll just turn it right over to you for your comments.
All right. Well, first, I just want to say thank you for this opportunity to discuss this report. Obviously, there's so much here, and I really do appreciate such a careful dive into the issues. So I am just going to raise 3 questions that I think we should emphasize. A lot of these are in the report, but I just want to really focus us. The first question is, what are we missing in the current conditions? Right? We have a deluge of data and lived experiences, but what do we need to focus on? What's something that maybe isn't getting the attention it should? And then secondly, I do want to go back to these downside and upside risks, because I do think it's really important, given so much uncertainty, that we think hard about those. And then finally, because I don't want this to be totally depressing, I want to talk about what would spur a faster recovery. So, okay. All right. So in the current conditions, we know for the second quarter, there was a big contraction. We are getting more and more data on the third quarter. We're going to get the United States third quarter GDP tomorrow. And these numbers were big on the downside. They're going to be big on the upside in terms of growth. The levels are still going to be depressed. I think it is extremely important that we don't take that big third quarter jump as just a snapback, pent up demand. We just started going back and spending. There was an incredible amount of relief that came out in the United States and other advanced economies. And we have seen the positive benefits of it. And then we have seen those disappear when the relief expired. What this chart is showing you is data from the JP Morgan Chase Institute. They have it at a household level. And you can see that they look at both those individuals who are receiving unemployment benefits and those who kept employed over this period. You can see an increase in the spending of the unemployed as those benefits were coming out late in the spring and the summer. Those benefits, the $600 extra a week, expired at the end of July, and surprise, surprise, their spending dropped off, right? So this is just to say that the relief was really important, and at least in the United States, it's gone, right? And then what we have gotten into is a very negative spiral in which politics and increasingly worries about the federal debt are stymieing more relief. And frankly, we're not going to see anything the rest of this year, which is absolutely tragic. And one other point to emphasize on this is, it's important to look at the aggregate effects. It kind of rolls it all up as a summary. The hurt across different groups in the economy is just massive. And it's practically inhumane. There are some groups that are getting hit really hard by the pandemic. And now that relief is gone, they are being hit really hard in terms of their family financial situation. Okay. Oops. That's right. Yeah, okay, so next I want to go, to the downside risk. And this was already said before, but the pandemic has driven everything about this crisis from start, and it will go through to finish. And the biggest risk we face is that the pandemic comes roaring back and we see a big surge. And frighteningly, it's happening, right? So this was the big downside risk that everybody who watched the economy and just lived in it worried about earlier in the year. And this is a very dangerous situation that has to get under control with all the different health measures that we now have. And the other thing that is a downside risk that is frankly in my most likely scenario, but I'll try and play it as a downside, is that the longer that this crisis goes on, the more permanent the damage is. And we saw a lot of temporary layoffs early in the pandemic when everybody was going home to stay safe. What we're starting to see is a lot of those layoffs going not from temporary to permanent, businesses closing permanently. This is really, really bad. And we know this from past recessions. It can knock people off an entire 10 years, and for young adults, an entire career. So this is bad. Upside risk. I'm going to try and get the trajectory of a little bit more optimism here to the end. And there is an aspect of the US economy, or any economy around the globe, that has a self-healing dynamic. So some of that jump that we were seeing in the third quarter in terms of output and income, that really is the economy snapping back, right? That would have happened regardless of relief, just because of some of the other dynamics of opening the economy back up. But we're taking a gamble here on that we have got enough of a positive spiral, the opposite of the negative spiral, into a recession. But if we have that positive spiral, and if it's strong enough and we don't have another surge in the virus, well, then maybe it would get us, it will eventually get us there, but maybe it'll get it there faster than what I think, and I think what's in the baseline for the IMF's outlook. And just to show that, we have been surprised at times. This chart is showing U.S. Payroll employment, and it dropped off a cliff, and we did see a pretty fast pace of recovery there, in the late spring. And I mean, I was surprised. There were a lot of forecasters that were surprised. We've continued to see an increase. It has flattened out, but this is the aspect of, well, the economy can, keep chugging along at a slow pace. And the other upside risk is, it's sad, this is actually a risk and not the baseline, is that politicians could regain the will to act forcefully, right? That's definitely the case in the United States. I think around the globe, we saw a fatigue as we went into the recovery from the Great Recession. And we need to not do that mistake again, right? But, we could learn from past mistakes. We could really get the act together among policymakers. And if that happens, then we will be in a better place than I think a lot of expectations right now. Okay, so just to close, I want to underscore that this is not what we are living baked in the cake. Like, this did not have to happen. We could have all been South Korea, right, which has had extremely good responses to the public health crisis, and that pays off, right? So, but there are things that we could do to improve the policy response, setting aside public health, which absolutely needs to get addressed. And one of the things that I've worked a lot on is thinking about, well, how could we tie economic relief to economic conditions, what is referred to as automatic stabilizers. The US and many other countries have these. A lot of Europe has much better automatic stabilizers built in already than in the United States. But the idea of this is you put policy on autopilot. You don't depend on policymakers in the crisis when they're getting tired to keep going. And the idea of this, in essence, is when people are back to work, they tell us that it's okay to pull, to start tapering off and ending this relief. And by relief, I mean things like the extra direct payments we send to people, the enhanced jobless benefits, and direct aid to state and local governments. So we can do this. Economists know what works. Policymakers know what works. It's just a matter of the will to get it done. So thank you.
Great. Thanks so much, Claudia, for those really insightful comments, and to Malhar for a terrific presentation. I think we're actually going to move on to the next chapter right now because we're starting to run a little low on time. So I'm going to turn things over right away to Francesca Caselli, who is an economist in the World Economic Studies Division of the IMF Research Department, and she'll present IMF research on the impacts of lockdowns and the virus. So it's a really, if you haven't had a chance to read the chapter, I commend it to you. It's a really helpful look at how to think about what the pandemic itself did to the economy and kind of a deeper dive on some of these issues. And our discussant will be Tara Sinclair of George Washington University, who is a real expert on real-time macroeconomic data and forecasting, and I think will give us a lot of helpful thoughts on this as well. So I'll turn it over to you now, Francesca.
So thank you so much to the organizers, and also to Tara for taking the time to discuss our chapter. So I'm going to present some of the findings of Chapter 2 of the current October WIO on the Great Lockdown, dissecting the economic effects. And this is a joint work with Francesco Grigoli, Wei-Chen Lian, and Damiano Sandri. We also received truly excellent research support from Junjing Li and Susie Sun. So as we all know very well, when the pandemic hits, most countries introduce stringent lockdown measures to sort of trying to stop the spread of the virus. But at the same time, economic activity started to contract very sharply on a global scale. So the aim of our chapter is really to try to dissect the nature of the crisis in the first 7 months of the pandemic. And against this backdrop, the first question we ask in our analysis is to what extent the economic contraction was driven by lockdown measures rather than by people voluntarily avoiding social interactions because they feared catching the virus or spreading it to others. So to answer these questions, we first estimate the impact of both lockdowns and rising infections on mobility, which is our proxy, high-frequency proxy for economic activity for 128 countries. And we find the following. So first, as expected, we find that mobility declines by about 25% 1 week after the introduction of a full lockdown, but we also find that higher cases lead to a considerable drop in mobility. And we interpret this as reflecting the role of a fear factor, of the fact that people are scared and hence they voluntarily reduce interaction. And taken together, these two results could be interpreted as as sort of explaining that both lockdowns and voluntary social distancing played a similar role in reducing mobility. And this is what we show in the chart below. So if we focus on the full sample, really, lockdown stringency that here we measure with the Oxford index of lockdowns really played an equal role to the one that we see on voluntary social distancing. However, if we focus on advanced economies, we see that the proportions are slightly different. And in particular, voluntary social distancing played a bigger role in the drop in mobility. And we interpret this as sort of possibly reflecting the fact that in advanced economies, people can more easily work from home because the share of teleworkable occupation is higher. They can also more easily rely on savings and also on retirement incomes. And this is not the case for emerging and low-income economies. What does this mean for the upcoming economic recovery? Well, we think that this is important because it suggests that lifting lockdowns cannot lead to a full and sustained recovery if health risks remain. In other words, the economies will not return to full potential as long as the virus continues to spread. So here I showed you some evidence that both lockdowns and voluntary social distancing entail negative economic costs, but we know that lockdowns were firstly introduced as an investment in public health to protect the most vulnerables and to reduce infections. So in the next section, we really ask whether lockdowns were successful in containing the virus, and we adopt a similar methodology to the one we adopted to study the effects on mobility. And here we see that a stringent lockdown reduces cumulated infections by about 40% after 1 month. It's also interesting to note that the effects on infections materialize after a few weeks, and this lag is consistent with the incubation period of the COVID-19 disease and also with the time required for testings. So on one side, we saw that lockdowns entail sizable economic costs, but they are also successful in containing infection. And as we all know, this argument is often used to say that lockdowns involve a trade-off between protecting lives, saving lives, and protecting livelihoods. However, we think that in light of the previous finding that I presented about the importance of the voluntary component, about the fear factor, this narrative might be misleading. And in fact, by containing infections, lockdown may lead to a faster economic recovery as people also reduce the extent of voluntary social distancing and resume normal activities. And especially this is true in the short term. I mean, the trade-off narrative might be true in the short term, but in the medium term, a faster economic recovery might compensate the negative short-term effect, so possibly leading even to a net positive effect in the longer term. So in the chapter, we also provide some further evidence to corroborate this idea that really both lockdowns and voluntary social distancing were crucial in driving the economic contraction. And we leverage the richness of job posting data kindly provided by the online platform Indeed to try to compare sectors that are typically more contact intensive, such as food, hospitality, and personal care, to manufacturing, where the social interaction is less present. And so here we are really able to confirm the earlier findings, focusing more on labor markets outcome. Here you can see that we plot over time the stock of job postings by sectors around the time of adoptions of national and state-owned orders. And you can really see that jobs in contact-intensive sectors declined well before the formal adoption of lockdown measures, while manufacturing jobs declined around the adoption of stay-at-home orders, suggesting that the fear factor really played a role for those contact-intensive sectors, whereas for manufacturing, the role played by lockdowns was more important. And so this is really helpful to sort of build more evidence towards the results that we showed with mobility. And here we can also speak more closely to labor market dynamics, thanks to this data that in fact are available for quite a large sample of advanced economies and also a few large emerging markets. Next, we take also another look at the effects of lockdowns, and I present these slides because I think it's particularly important now, as most countries are again debating whether to introduce lockdown measures. And here we try to assess what is somehow the optimal timing of lockdown adoptions. And we show that countries that adopted lockdowns early on had better epidemiological outcomes. So here we differentiate countries along two dimensions. First, the left chart differentiates countries based on the number of days between the first case and the maximum lockdown stringency. And the right chart differentiates countries based on the number of per capita weekly cases at the time of maximum lockdown stringency. And you can really see that in both charts, countries that acted early on, that were like fast tighteners, had lower cases. So this speaks now to the debate about whether or not to introduce new lockdown measures as cases are surging again. So far we looked at the aggregate impacts of lockdowns on the economy, but as we all know, lockdowns really have distributional effects, and the literature has been looking into those, and we try with our chapter to contribute to this literature, in particular by looking at the effects of lockdowns on women and on young people. We do so using new mobility data provided by the telecom company Vodafone, which are disaggregated by both gender and age. These data are available for 3 severely hit European countries, namely Italy, Spain, and Portugal. And they're particularly granular as they're available at the provincial level. So first, we look at the impact of lockdowns on gender. We know that women were severely hit by lockdowns, first because they are often employed in services, in some of the services that were really affected bad, personal care, hospitality, and so on, and also because school closures really impact women that most of the time have the highest share of childcare at home. So in the left-hand side chart, we look at the impact by gender, plotting the fraction of people moving around the time of adoption of stay-at-home orders in the age group 25-44. We focus on this group because these individuals are more likely to have young kids. And you can see that the mobility of both men and women dropped sharply at the time of lockdowns, but the mobility of women drops more significantly. And when we focus on some Italian regions where school closures happened well before national stay-at-home orders, we see that actually the gap in the mobility between men and women started to open up at the time of school closures and then further widens at the time of national stay-at-home orders, suggesting that both measures really had a more significant impact on women. Second, we look at impact on different age groups, and this is what we show in the right chart. So you can see that stay-at-home orders reduce mobility of all age groups, but the young, those in the group 18-24, were really more affected. And this is concerning because young people are those that rely more on labor income with respect to, say, retirees who can draw from saving as also retirement income, and also they tend to have less stable jobs that are more at risks when lockdowns are introduced. So these two results are really important, and they highlight the fact that the crisis may widen even further gender and intergenerational inequality. So we call for targeted policies to prevent this from happening. So let me summarize our finding and conclude. So we have seen that both lockdowns and voluntary social distancing are both key determinants of the drop that we have seen in economic activity. And given the important role played by the voluntary component, economies are unlikely to return to full potential while health risks remain. And therefore, policymakers should be very cautious of removing policy support too rapidly. We saw that this narrative about a trade-off between saving lives and protecting livelihoods might be misleading, especially in the short term, because by containing infections and reducing voluntary social distancing, lockdowns may lead to stronger economic recovery. And also, we saw that early and tight lockdowns are powerful instruments to contain infections, but we all know that they are also very costly. So policymakers should find less costly way to contain infections, such as face mask usage, cleaning protocols, and isolate the most vulnerable. Finally, we saw that lockdowns tend to have more severe effects on the mobility of women and the young, and this clearly calls for very targeted policy interventions, for example, strengthening unemployment benefits for vulnerable categories and supporting paid leave for both parents so that they can both take care of kids while schools are closed. Thank you.
Terrific. Thanks so much. That was a great presentation, really insightful. And so I'd like to turn it straight over to Tara Sinclair with some comments.
Great. Thank you so much, Jay. And thank you so much for the opportunity to discuss this absolutely fascinating chapter. It honestly has all of my favorite things in it. Most notably that they're taking a deep dive look at the causes and consequences of this deep economic contraction using really cool data. So I have to just get really excited about this opportunity to discuss this. And so I will note from the outset that I was involved in getting some of the Indeed data out the door to the IMF. So I'm particularly excited about their use of that data. But I have a lot of experience working with private sector data. So I will mention some pros and cons as I go through my discussion. So much to discuss in this chapter. This is a beefy chapter. And so I'm just going to try and quickly run through 4 points where I'm going to have lots of other things I'm going to want to say, and I'm going to have to cut myself off. But I'll briefly cover the key insights, the cool new data, and of course I'm going to have requests for future research, and conclude with a few shameless plugs. So first of all, just highlights of the key insights. Francesca did an excellent job going through this as well. But first, I'm going to have like a brief naming quibble, and then I'll get on to the cool stuff. And the naming quibble is that it is about talking about this recession as the lockdown recession. And this is not particularly with this chapter. This is broadly with how the IMF has been talking about this. And I actually feel like this chapter is pushing against that as well. I've been calling this recession the novel recession because we were calling it the novel coronavirus. And unfortunately, I fear that this might not be the only pandemic recession. It's probably the only COVID-19 recession, so we could be that specific. But I think the important thing is to emphasize that it's not that governments imposed lockdowns just for funsies. This was really, it's caused by the pandemic. And I really want to put that responsibility there. And the health response that governments took, I see, and this is me pushing also against these sorts of trade-off type discussions, because when we think about the lockdowns, they were both protecting health and the economy. Having a bunch of people sick is a negative for the economy. These are not trade-offs. And so I really like this chapter and the discussion about both the lockdowns and the voluntary social distancing. But we're all doing both of these things because there is this very evil virus out there trying to kill us. And so, I like this saying that, okay, and some of it is voluntary behavior, some of it's lockdown stringency in terms of the impact on, job postings or on mobility or any proxy that they look at for thinking about the role here. But really, these are responses to something even deeper, this pandemic. And I always think it's important to emphasize, as Chair Powell has been doing, that this full economic recovery is unlikely unless people are confident it's safe to re-engage in a broad range of economic activities, and that's right in line with what this chapter is saying. So to hit the key highlights, I picked 3 figures. And I think that the subheads for each of these really tell just such a clear story, right? There's more stringent lockdowns are correlated with sharper economic contractions, but that's not the only piece, right? That obviously behavior also matters. Women and younger workers are disproportionately affected by lockdowns. I think that that's a really important piece to think about, that the way that we respond to the virus does have these distributional impacts. And so we do want to consider those factors very carefully, particularly as we're trying to learn from this pandemic, not just about, we're trying to fly the plane while building it right now in terms of our policy response. But hopefully we're also learning, because as I said earlier, I don't think that this is the only pandemic recession we're probably going to face. And so if we can learn from that now and have better policy responses prepared and in place for the future, I think that will be really important. And then the third figure showing that lockdowns are an effective tool to reduce infections, especially when they're implemented early in the epidemic. Again, I think that that's really important for emphasizing that lockdowns are not this evil thing that are causing economic turmoil, but they are saving lives. So that's kind of my triptych of this chapter. So briefly on to cool new data. And what I think is cool about all this private sector data that researchers are really digging into, particularly since March or so, like all of these new data sources have suddenly become available in response to the COVID crisis. In part because people wanted super timely, super high frequency data. Suddenly that was really valuable. But in the longer term, it's the granularity of these new data sources that I think are going to give us really cool new insights for policy. And we're already seeing some of those uses in this chapter, both geographic granularity, geographic representation with common resources and methodologies and definitions, but also being able to dive and look at different sectors of the economies and that sort of thing, I think is really cool about the data. I will say that we need to use these data with caution. These are not representative samples. These are not created by government statistical agencies that have been clean. Economists, we are spoiled with really nice, clean data from a lot of sources. But I really like the way that the chapter uses these data sources. And in particular, I'm going to skip over that. That was just my warning that we at Indeed take the data seriously. But what I like here is that we're looking at triangulating the information from different data sources. So in this one chapter, they're looking at mobility, they're looking at job postings, and you've got 2 different sources of mobility information. You could add in others as well. And then, of course, this really awesome resource from the Oxford group that's doing the government response tracker. And bringing all that information together at once rather than just focusing on one single data set, I think does kind of robustify our use of private sector data. So I think that that's really important. And it's still important to realize that all of these data sources, in some sense, are potentially not representative in the same sorts of ways. And so that's always a grain of salt thing that we need to think about, and particularly when we're making policy decisions, that thinking about not everything happens online, not everything happens with a mobile phone, and really watching that sort of information carefully, and as much as possible bringing in the representative publicly available data, because I think of these things as complements, even if we have to wait a little longer for some of the cleaner, more representative data. It's good, as we're making longer term lessons to look at that. And I have more to say about those things, but I won't. So quick request for future research. I was surprised that this chapter did not talk more about separating supply versus demand. And then also, there's some hints about talking about the midterm effects versus the short-term effects. I'd like to even get into the long-term effects and thinking about what reallocation means in this environment, and also things about bringing forward the future. So I made another little flow chart here where I think about the pandemic led both to us feeling unsafe to produce and unsafe to consume. The unsafe to produce, kind of directly lowered output and raised costs. But the unsafe to consume, also lowered demand. And so if we see lower output and lower demand, both of those we're seeing lower income. And then that's when we see what I would think of as the more traditional demand side recession. And that's still potentially coming down the road. Claudia already brought that up. So that's something that we've got to continue to keep an eye on how we're going to recover from that. But then we've also got a lot of potential. People have talked about creative destruction here and reallocation and what parts of our economy might permanently look different rather than just temporarily. And so if we think about faster technology development and adoption, bringing forward the future in a lot of ways, some of this might slow our recovery in the short term, but might also result in better longer term outcomes if it works out the right way. So I think that's something to watch for, and of course to watch for the distributional impacts of that, and for policymakers to really keep that longer term distributional impacts in mind as well. I think is really important. And so I will just fly by these shameless plugs and note that there's lots of other cool uses of the Indeed data specifically on hiringlab.org. So here's just a smattering of reports. But the thing I'm really excited to share with y'all is that as of last night, the job postings on Indeed, not all of the fancy stuff that Francesca has access to, but a subset of that is now available on Fred. And so it's also available for other researchers to work with as well. And I will say thank you and stop there.
Great. Thanks so much, Tara. That was a terrific set of comments, a really interesting chapter and conversation about it. I think, as you said, there's lots of fascinating data that researchers are now getting their hands on and doing great work with. So thanks for that. We're going to move straight on to talk with a little bit of a shift to talking about the environment. About climate. And we've got Florence Jomat, who is a deputy division chief in the research department of the IMF, who is going to talk about mitigating climate change, growth and distribution friendly strategies. And then we have Ken Gillingham of Yale, who's an associate professor of economics in the School of Environment and the economics department, who will be the discussant. I also worked with Ken, in addition to Claudia, back at the White House CEA, where he very patiently taught me a great deal about climate economics. So I'm very much looking forward to Ken's comments here. So Florence, I'll turn it over to you.
Good afternoon, everyone. Thank you very much for the invitation to present today. And thank you to Ken Gillingham for accepting to discuss the chapter. I will present you highlights today from the WIO Chapter 3 on climate mitigation policies, growth and distributional friendly strategies. I encourage you to take a look at the chapter and the online annexes where there is much more material covered. This chapter was prepared by a large team of economists in the research department of the IMF, as well as in collaboration with external consultants. Now, the window to limit temperature increases to safe levels is closing rapidly. As you probably know, the average temperature over the surface of the Earth has increased by about 1 degree Celsius since the pre-industrial era. If we continue with unchanged policies, temperatures could further increase by between 2 and 5 degrees Celsius by the end of the century, which are temperatures not seen in millions of years. This would impose large costs on the world economy and could even lead to the risk of catastrophic outcomes. Indeed, scientists have warned that to avoid catastrophic outcomes, we should try to limit temperature increases to about to below 2 degrees Celsius and preferably around 1.5 degrees Celsius. And this objective was endorsed by policymakers worldwide in 2015 at the Paris Agreement. Now, in practice, maintaining temperature increases within these limits would require bringing net greenhouse gas emissions to about zero by mid-century, so not so far from now. Now, the current global crisis may make it more difficult to act on climate change, but it also presents unique opportunities. First, the fiscal stimulus, which will still likely be needed in the aftermath of the crisis, can be an opportunity to boost in public investment, infrastructure investment that's green and resilient. Also, policies can seek to ensure that the recovery in capital spending that will take place is consistent with decarbonization by providing correct price signals and other financial incentives. Now, against this background, the chapter tries to answer two questions. The first one is, how can we reach net zero carbon emissions by mid-century in a way that is supportive of growth, employment, and an equal distribution, income distribution? And the second question is, can these well-designed and well-sequenced mitigation policies actually support the recovery from the COVID-19 crisis? Now, in the first part of the chapter, we start by looking at policies that have been implemented so far and how they have worked. And for this, we use the Environmental Policy Stringency Index from the OECD. As you can see in the chart on the right, environmental policies have strengthened over the last 3 decades. And this has come together with an increase in global innovation and investment in clean energy technologies. Our econometric analysis suggests that the tightening of environmental policies contributed to about 30% of the increase in global clean energy innovation, and about 55% of the increase in the share of renewables in electricity generation. Now, there are concerns that climate policies will lead to job losses, especially in carbon-intensive sectors, such as coal mining, shale oil and gas production, carbon-intensive manufacturing, or the transport sectors. In the econometric analysis that we did, we find that actually environmental policies led to a reallocation of jobs from high carbon to low carbon sectors. Low carbon sectors being, of course, renewables, but also low carbon manufacturing or services. And the net, when you look at the net effect on aggregate employment, it's pretty small. But as we know, job transition can involve important costs for the workers that are affected, and therefore it's going to be important to look at how we can mitigate these effects. I'm trying to move to the next slide here. Yeah. Now, in the second part of the chapter, we try to look at mitigation policies that can take us to net zero emissions by mid-century. Now, governments can use two broad types of instruments to curb carbon emissions. The first one is carbon pricing, and the second one we call green supply policies. Now, carbon pricing means raising the price on carbon, either through a carbon tax or through carbon emissions trading schemes. Green supply policies means that we try to increase both the abundance and the affordability of low carbon energy sources. Now, this can be done through subsidies and price guarantees in the low carbon energy sector, direct public investment in low carbon infrastructure and technologies, or also research and development subsidies. Now, what we will try to argue in the chapter is that when we combine these two types of policies, green supply policies, and carbon pricing. In principle, we can prompt rapid and strong declines in emissions, and at the same time avoid having a big negative impact on economic activity and employment. So let me walk you through the arguments. So the chapter takes as objective to reach net zero emissions by mid-century, and the way we operationalize this is by an 80% reduction in gross emissions. So we assume that the remaining 20% of emissions are absorbed through deployment of carbon capture and storage, or an expansion of natural sinks, such as forests. We model the effects of the policies with two different modeling approaches, which are used in complementary ways. The first one is a global macroeconomic model, which is called GQ, and which has a number of interesting features that are well suited for us to look at the macroeconomic impact of these mitigation policies. In particular, it does have forward-looking agents, it has real and nominal rigidities, and of course, fiscal and monetary policies in the model. At the same time, it has a detailed energy sectors in the model. We also combine this with an integrated assessment model that allows us to derive increases in temperatures and climate damages implied by the emissions. Now, we do look at a comprehensive, or we propose a comprehensive macro package in the chapter, which consists of 4 layers. The first one is the green supply policies, which is a subsidy on renewables production and a 10-year green public investment program. The second component is a carbon tax that's very gradual. It starts at a very low level, but grows then relatively quickly. The third one is a compensatory transfers to households. So about a quarter of the carbon tax revenues is used to protect the purchasing power of poor households, and this is to try to ensure a fair transition. And the last leg is a supportive macroeconomic policies. So initially, this policy package implies some fiscal easing that's financed by debt, but in an environment of low for long interest rates. Now, this package allows to deliver the required emissions reductions at very manageable costs, and that's what is here, and I'm going to explain in more detail. On the left-hand side, you can see the CO2 emissions. The baseline is the red line, so that's what would happen under unchanged policies. You can see that the infrastructure, the green infrastructure investment, does reduce emissions, and that's the green line, but it's much less effective than the carbon tax, that's the blue line, which provides the bulk of the emissions reduction. And the reason for the strong effectiveness of the carbon tax is that in addition to increasing the relative price of high carbon energy relative to low carbon energy, it also tends to increase the overall energy price in the economy, and therefore it incentivizes energy efficiency, which, policies that subsidize the use of energy, like green supply policies, don't have that additional channel to reduce emissions. So carbon pricing is really essential to deliver rapid and substantial reductions in emissions. On the right-hand side, you see the impact on real GDP in deviation from baseline, from what would happen in the baseline. What you can see is that carbon pricing does tend to reduce lower GDP because it increases the cost of energy, and that's the blue bars in the charts. On the other hand, the green infrastructure stimulus tends to boost GDP above baseline, and that's in the short term because it increases aggregate demand, it stimulates government spending, and in the medium term because it increases productivity in the low carbon sectors. And therefore, it incentivizes more private investment in these sectors and tends to increase the potential of the economy. So there is a more sustained effect on the supply side. Now, over the first 15 years, the effect of the green stimulus is large enough to comfortably offset the drag from the carbon tax. And therefore, the package supports the recovery from the COVID crisis, both on the output and employment side. After about 15 years, as the package increases the carbon taxes, the drag from the carbon tax becomes larger, and the net of the package results in small net output losses, which reach about 1% of baseline GDP by mid-century, and that's the red diamond in the chart. Now, this is very manageable when you take into account that the global economy is actually projected to increase by about 120% between today and 2050. Here we're just talking about a 1% reduction in GDP compared to what it would have been. And if you take into account the fact that mitigation policies also yield important co-benefits, and by that I mean health benefits which result from lower pollution, the package could actually be neutral for global output, and that's what we show here with the little black dot. I'm going to skip one slide just in the interest of time. Let me mention a couple of additional results. The first one is that these transition costs, so the 1% I was mentioning before, they vary across countries, of course, and they're likely to be larger for fast-growing countries, for example, India, and for oil exporting countries. But these transition costs need to be weighted against the avoided damages from climate change in the future and the co-benefits I was mentioning, like the health, the better health outcomes. And for some of these countries, these avoided damages or co-benefits can be quite large and do tend to offset transition costs. It's not true for all countries, but it is true in some very important cases. Second is that advanced economies cannot mitigate on their own, and that's because their share in global emissions is relatively small and declining. But if the top 5 countries were to act jointly, they could make a large dent in global emissions. The third point is the development of technologies will be a key enabler of the transition and would make it less expensive. And there is a strong case to accompany the policy package R&D subsidies, especially early on, because they take time to lead to the development of new technologies that then need to be brought to the market. Fourth point is that trade-offs are currently more favorable in the electricity sector, so to decarbonize in the electricity sector, because in the electricity sector, alternative low-carbon technologies already exist and are economically competitive, so they can, we can decarbonize at a relatively low cost. In the last part of the chapter, we look at how to build inclusion. So more precisely, we look at what would be the distributional effects of carbon prices and how can we mitigate them to ensure a fair transition. Now, carbon prices produce differentiated impacts on low and high income households and also on workers that are in high or low carbon sectors. Let me say a few more words about these. So low-income households, they are likely to be more impacted for 2 reasons. The first one is because they spend a relatively larger share of their income on energy-intensive goods. And that's true in many countries, though not in all countries. The second reason is that they tend to be employed in skill occupations in carbon-intensive sectors. When we look at public opinions, and that's what we show in the chart on the right, low-skilled workers are likely to be less favorable to protecting the environment over boosting economic growth than high-skilled workers. And of all, the ones that are the least favorable are the low-skilled workers employed in high-carbon occupations. Now, governments can use different policies to limit the adverse effects of higher carbon prices on lower income households. And one option is to rebate part of the carbon revenues to households through either universal or targeted cash transfers to protect their purchasing power. A second option would be to spend some public money on low carbon sectors to try to support job transitions towards those sectors. In the chapter, we use modeling analysis to look at these impacts and the effect of the policies. And we find that using about 1/6 to 1/4 of the carbon revenues to redistribute them to households as cash transfers would help fully offset the negative impact on the 20% poorest households. And these numbers are for China and the US. If we wanted to protect the consumption of the bottom 40% of households, we would need between 40 and 55% of carbon tax revenues. Now, in practice, governments are likely to face pressures both to protect purchasing powers of households and to support job transitions to low carbon sectors, and they can use carbon revenues to do both. Let me quickly conclude now. Net zero emissions by 2050 remains a feasible objective that would boost incomes in the long run and put the economy on a much more sustainable path, but the window is rapidly closing. What we show in the chapter is that we don't have to choose really between supporting the economic recovery from the COVID-19 crisis or putting the economy on a low carbon path. If we combine an initial green investment push with steadily rising carbon prices, we could achieve the emissions reductions at reasonable transitional output cost and even a boost to the economy over the first 15 years. Finally, a fair transition requires compensating lower income households, both for higher carbon prices and to support their job transitions to low carbon sectors. Thank you.
Great. Thanks so much, Florence. Ken, let me turn it straight over to you.
So, first of all, thanks for those remarks were very, very clear. It was a really pleasure to read this chapter. It was really very, very well done and researched. Given that we're already kind of at time, I'm going to move pretty quickly here. Make sure that I'm within my 5 minutes. But I want to really emphasize that this work could not be more timely. This is really a carefully researched analysis and discussion of a major policy proposal package. It goes without saying, it's become increasingly clear that the cost of inaction on climate change is very high. And this is something that's just becoming, the science is building. It's very, very clear that this is the case. And much of the world is at the cusp of massive new stimulus investments, either at the cusp, depending on who's elected in the US, but also thinking more broadly, globally, many countries are considering or have implemented. And we see, EU approves $572 billion plan. The numbers being batted around in many respects are in the trillions. So this policy package that's being proposed, I think falls into this category of well-founded new ideas that come at a very timely, that are very timely right now. This package of policy proposals is very ambitious. It is aiming to achieve an 80% reduction in gross emissions. So that's intending by 2050, intending to get us to net zero emissions by 2050, where the remainder would be carbon sinks. And it has these three components. It has a carbon pricing component. This is differentiated by country, and it starts low and is increasing over time. And by low, we're talking many countries are in the $10 range and in the low range, and it kind of ramps up towards very high levels. And by 2050, we're talking well over $100 per ton of carbon dioxide. It includes green investment policies. This includes an 80% subsidy on renewables, along with a 10-year green public investment program that starts at 1% of GDP and then declines linearly to 0. So this 10-year green public investment program is really quite timely. This is very much about getting people to work. Now, obviously, we need to get the pandemic under control, but this is a time when we are really facing severe economic issues around the world, and this timing is just perfect for that. Then it involves transfers. Poor households will receive compensation. So the carbon pricing will raise revenues. Some of these revenues will go to compensate those who could have been harmed. This is a really interesting set of policies together. With this set of policies, we're going from a business as usual set of assumptions of global emissions looking like this. This would be kind of a world where we don't do much in the way of policy, or modest policy, I suppose, and to a world where we have much lower policy. So the red line on this figure on the left. And it really makes a difference. I think these numbers are right in the right ballpark for what you would expect for temperature. So looking on the right-hand side, you really do see a clear effect. And one of the things about it is that many climate scientists say that we should try to stay below 2 degrees C. Many scientists say we should try to stay below 1.5 degrees C, which is already looking untenable. This would bring us below 2 degrees Celsius of the mean surface temperature by 2050. So my first reactions from reading this, I enjoyed reading it. It was, great set of references, well thought out. This policy package is overall hitting a lot of the right notes. It roughly aligns with, I like to think about things as an economist by what market failures are being addressed. And there are dual market failures. There's a climate market failure and there's an innovation market failure. And as well as a serious consideration given towards equity. And I do believe that that's important, both from a positive reason and a normative reason. On the positive side, getting the political will to bring across this kind of spending and carbon pricing is not always going to be easy. So the equity consideration is important there. And then on the normative side, just purely from an ethical perspective, there's a reason to consider making sure that equity is considered. I do believe that this 10-year investment program would be incredibly valuable in solving a whole set of challenges. There are chicken and egg network externality issues when you think about charging stations in electric vehicles, as well as there are a whole set of other things that are going to need to be done, such as building out new transmission lines when you put in high levels of renewables, making sure that there's backup generation, which could be green hydrogen, for example, or other options there. Making sure that there's enough energy, enough energy storage, if battery prices come down enough. So that's important. One thought is that prices of renewables have been dropping really rapidly. This is something I've been following. I followed it very closely in 2015-16 when I happened to be working for the government, but I've also been following it along the way, and the drop has been quite substantial. What I have here down in the corner are the Lazard latest numbers, and now, you may take these with a grain of salt. They don't account for intermittency and a variety of other things, but these numbers have really been coming down. And what we have down at the very bottom are conventional fuels and nuclear, coal, gas combined cycle. The dots or diamonds that you see tell you the values for currently existing plants, and the bars are the ranges for new builds. And we look already, wind and utility scale solar is on par with currently existing plants. This is just for the US. I also looked at some IEA numbers. IEA's numbers are a little more dated. This is kind of brand new, right off the hot off the presses from really recently. But IEA's numbers are, as of a year ago, aren't that different than these numbers. So renewable energy is dropping very quickly. So given that it's an 80% subsidy is a very substantial subsidy, I'm not sure that subsidy will be fully needed to bring on the amount of renewables that are coming on in this scenario. But I completely agree with the conclusion that electricity is going to be one of the easiest places to decarbonize. And I think the dropping prices are going to emphasize that even further. There are several highlights in this study. This is the first analysis of such a policy package that I've ever seen, and so I really liked it from that perspective. I really like this idea of sequencing policy. This is an area that's ripe for further research. There's been some discussion about sequencing. There are people who have written, there was a paper recently in Nature Energy saying how important policy sequencing is, but there's not a lot of actual work. This work sequences policies such that the green supply investment brings down the carbon price needed later. So this is a bit of a policy interaction that I thought was really neat, and I liked a lot. So the green stimulus brings down the costs of renewables, brings down the cost of clean technology more broadly, and that allows you to achieve decarbonization at a much lower carbon price than you might have needed otherwise. For reference and some context, it's thinking about what many of the other models kind of show without this green stimulus, and I bet G-cubed would be no different, is you need a very high carbon price to really push all the carbon out of the system by 2050. Much higher, which means a much more stringent policy. So this, I thought, was an exciting part of this. Another highlight is the effects of the package on GDP are also novel, and I think are very important. The fact that we see the simulation total, which is the gray line on the left above, having a positive effect of GDP because of this investment package, which I think in the next few years is going to be really important as we recover from the pandemic. And it does go negative because carbon pricing has an impact. It raises energy prices. But then it's going to start going positive again, which isn't included in this figure, but is included in the separate figure on the right, in that we're looking at the idea that there are going to be larger climate damages. So this figure on the left only goes out to just past 2050, going out to 2070 and 2100, the levels of climate damages really substantially increase, and that'll bring this back. So from a very long run perspective, you're going to be back into the positive. So not only are you kind of in the positive on the GDP in the short run, you're also setting the stage for our next generation to be in a much better place than they would have been otherwise. So I want to conclude with some potential thoughts to consider. There's a lot of uncertainty when modeling out to 2050, and I know that the modelers at the IMF fully recognize this. There's a lot on uncertain technology costs. I already mentioned how quickly renewable energy costs are dropping, and how those are modeled to drop going out further is crucial for a long-run analysis. And so I view the results as reasonable central case type estimates, with, especially as you're going out further towards 2050, with very large confidence bounds around them, because we don't know the exact path of technological progress. And in fact, there may be multiple paths of technological progress, which actually brings me to something that I really like here, is that by having this investment in the beginning, if there are going to be path dependencies in technology change, this is more likely to lead you down to a path of low carbon technology, which will allow you to get to a more inexpensive way of decarbonizing. Noting that CG models generally tend to have difficulty in getting us to a zero carbon world. So this was actually pretty interesting to me that they actually managed to do that by 2050. Green supply policies may not lower energy prices is a point a minor point, but an interesting one that I noted, is that these green investment policies are listed as lowering energy prices, but to the extent that they're putting in that they're going to be sunk costs that have to be borne eventually by ratepayers and others, they may or may not lower energy prices. And then I had a set of questions. Are there resource constraints in G-cubed for renewables and fossil fuel? Was it tough? It was tough to assess the empirical work, so I had some questions about that, but it actually broadly seems sensible to today. I wonder about extrapolating it out too far, but I think it makes a lot of sense today. Jobs estimates, they tend to always be tricky. I take these as kind of averaging over the business cycle, because business cycles are not built into a model like the G-cubed. And then finally, I'm curious to know about assumptions about technology transfer to the developing world. I sense that that there are assumptions about technology transfer, especially in low carbon technologies, that are built into these numbers, but that wasn't mentioned. But overall, I really want to say this was an excellent, well thought out chapter, and I really enjoyed reading it.
Well, thanks to all the presenters. Thanks for all the discussants. We're a few minutes over our time, and I really think we probably ought to let our audience go, but it really has been a great discussion. Everyone has just really risen to the occasion. So thank you so much for all your insight, and I know that the audience also thanks you. We thank the audience for being here as well. And thank you all from IIEP here in downtown DC. Until next time.